We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Kevin Muir, author of the Macro Tourist newsletter and Substack, and also the co-host of the Market Huddle. Thanks for joining me today again, Kevin.
It's great to be with you today, Tom.
So, Kev, when we look at this current macro environment, is it one of the most complicated and complex times to analyze when we see the seemingly opposite reactions from the market when we get, for example, the highest CPI print in 40 years?
For sure, there's a lot of different cross currents, and I think a lot of people are having trouble distinguishing the different pieces and what's happening as the market as this evolves. You mentioned that it's the highest CPI print in X number of years, 40 years or 4 decades. If you actually look at the month over month figure, you'll see that this month was actually, there was no inflation. And this is the part that people are missing and having trouble with, is that, yes, the last 11 months had tons of inflation. If you go look at the CPI index and you look at it, a year ago, it was 8% lower. And today, here we are, or 9% lower. And here we are today with it much higher. So it feels like when you're looking at the year over year figure that there's all this inflation. But the reality is that if you start looking at the month over month figure, you'll see that inflation is actually might have just peaked. And I think that that's what the market is seeing through. And this is occurring at a time when participants are positioned for an extremely hawkish Fed that might not be as hawkish as they think. And what we're seeing, therefore, is a huge squeeze higher in risk assets, and because most people are positioned incorrectly.
So is it possible that the market has now really priced in the worst of inflation and that we are at a possible turning point in the markets as we might be seeing, as you said, inflation topping for the moment?
So one of the problems with inflation is that there's different markets looking at it. And what, I think you're asking me about the stock market, and what the stock market is priced in for inflation and the subsequent Fed response is much different, I think, than what the bond market is priced in, which is also different than what the inflation swaps and like those traders have priced in. If you go look at inflation traded by the small part of the Wall Street that just trades inflation, they trade things like break-evens, inflation break-evens, which are basically tips minus the nominal yield, or they trade actual inflation swaps. You'll see that 1 year inflation, those swaps that were used to be 5-6% 3 months ago, have collapsed, and we're now at 310, 320 in that kind of range. So that part of the market has already completely and utterly understood that inflation is coming in and is priced, has changed their pricing. I think, if anything, that part of the market is overly optimistic about inflation coming in, and that they're expecting us to return to a more normal level, whereas I think that we're going to have continued inflation for a long time. But when we look at, let's just go to the stock market has seen, they focus on these big year over year prints. They don't think about kind of the grander picture, what the Fed's working with. And they're priced for inflation to continue forever and for the Federal Reserve to basically tighten into a recession. And that's what we had increasingly priced in. And that's why we're getting such a large rebound in the stock market, is that we had priced in a recession. And I saw this great study, Tom, by NDR, Ned Davis Research. And what they showed was stock market corrections throughout the years, the ones that are large, like 10, 15, 20, 25%. And they aggregated all of them, and they chose the corrections that were just a regular correction along the way, and those that the corrections were the start of a recession, meaning that inevitably ended up being a recession. So 2008, 2000, those corrections. And what you'll see is that the start of the decline looks the same. When you're first going down that kind of the initial slope, You don't know if it's going to be if the recession's coming or not. You just know that you're worried about it. The market's worried about it, so it sells off. Then we get a rally, and that's what we've experienced in the last little bit. And we've actually hit the point where one of two things has generally happened. One is the economy rolls over, goes into a recession, and the stock market heads lower. Mm-hmm. And from there, it'll typically give up another 10, 20%. Or in the cases where there is no recession, what you'll find is that after a little pause at this point, it actually takes off and goes higher. And I think that what is happening was the market was completely and utterly convinced that we were going to have the recession scenario. And now all of a sudden, with these inflation numbers coming in, not as hot as everyone expected, they're saying, hey, wait, we thought that the Fed was going to tighten us into a recession. With this inflation coming in, we're now at a situation where maybe they won't tighten us into a recession. And this is just another correction along the way. And I think when you combine it with all the sentiment reading about what most institutional, their exposure to the stocks, it's underweight. I think you have all the makings of a rally. And unless you think for sure we're headed into a recession, selling stocks at this point is not a good bet, in my opinion.
Mm-hmm. That's an interesting distinction I think we need to make is when people talk about the stock market versus the economy. I've heard you make that distinction a couple of times. So, why do you think a lot of people get that wrong?
Well, because if you think about stocks, they should reflect over the long run the growth of the economy, because that you're buying the equity, you're buying the growth, and over the long term, yes, stock market returns are highly dependent on the economy. But over the short run, the stock market runs ahead of the economy. There's different factors upon which, interest rates affected in terms of the discounting of the cash flows from the earnings from that economy. There's a million different things, but the economy is not the stock market. They are two different things. And you'll often see that coming out of a recession, by the time the recession is there, you almost want to buy stocks, because at that point, the stimulus is coming and that the Federal Reserve or the central bank or the fiscal authority is going to stimulate. So the stock market is a forward-looking mechanism, and therefore you have to adapt for that. And so we are doing what the Keynes talked about, this beauty contest. We're not just trying to judge. I know that's not a very politically correct thing, but Keynes was old. We'll have to forgive him for this. But we're not just trying to judge the entrance to the beauty contest. We're trying to judge the judges, meaning that we are trying to figure out not what is going to actually happen, what everyone thinks is going to happen, and then therefore get ahead of that. Mm-hmm. And that's unfortunately why it gets complicated. And there's these different kind of issues, and you always have to ask yourself, what is priced in? Everyone thinks, okay, how many times have you seen it, Tom, where there's bad news and the stock has terrible earnings and the stock rallies on the news? And the reason is it's priced in, and just the opposite happens. And the same thing occurs on macro, and it doesn't seem as obvious to those who aren't following it closely, but you'll definitely see situations where it ends up being that the worst is priced in. And I think that's what happened. Like a month ago, I got less bearish and I actually covered all my shorts and just started to lean long. And the long and short of it was, I just said to myself, everyone's already short. Everyone's already sold. And it was that simple. And there really was not much more to it than that. It's just that I said to myself, if I'm right, for me to be right on the short side, I need a great financial crisis kind of collapse or a 2001 collapse. And yes, those things happen, but I don't want to bet on them. Like on the whole, that's not the right bet. And for a variety of different reasons, I said, okay, this is the time to start leaning long. And even now, I kind of laugh. Like, Tom, I don't hear anyone talking about the potential new highs. I watch Bloomberg every day. All I see is people telling me bear market rally, bear market rally. Mm-hmm. There's nobody who believes in this rally. Nobody.
So, to your point there, Kevin, do you think that as everyone is bearish and that overall sentiment really, is predominant in the space, is this an indication to you that the consensus could be wrong? Are you only using sentiment, or are you also using the market indicators that you're looking at to make that judgment of the market?
Well, there's a bunch of different things. Like I don't just say, oh, everyone's bearish, so therefore I have to be bullish. I look at it as like, this is, now that everyone is this way, I have to ask myself, what is the risk reward setting up? Like, I have a variety of different choices. I can bet long, I can bet short, or I can not bet at all. And so I'm always kind of judging those things and thinking about how how it's evolving and trying to pick points where I think that the risk reward is in my favor. I happen to be much more of a bull in terms of on the real economy than most. And the reason for that is that I believe in my heart of hearts that we've spent the last 4 decades trying to fix everything with monetary policy, meaning that every time there was a slowdown in the economy, the government's lowered rates. And that works at the beginning when there's very little debt. But then towards the end, when more and more debt is piled on, it ends up being that the private sector can't respond. So much so to the fact that in 2008, when we had the crisis, the government tried to lower rates to zero and nobody wanted to borrow. And so we have this situation where monetary policy had become very ineffective, and we had assumed that this was the way the economy worked. And we had forgotten about the ability to use fiscal. And what happened with COVID was a reemergence of the ability to use fiscal. You can call it MMT, you can call it just a return to Keynesian economics. I don't think it matters. What matters is that they used a lot of it and they put a lot of money into people's jeans. And that money is different than when you give away money through lower interest rates, because at the end of the day, someone needs to want to borrow for lower interest rates to work. And if you don't have the ability to have credit to be created, then it doesn't matter what you do to interest rates. It just doesn't work. Like, look at Europe. Europe goes and they actually give rates away at negative, yet no one wants it because A, they don't have the ability to take down credit, and then B, the economy stinks. So why take out credit if the economy stinks? In this case, we just literally shoved money into people's jeans and we created a huge economic boom. And I think that we are underestimating how much we improve people's balance sheets. I think that once the Fed goes on hold, I suspect that the private sector credit creation will once again take over. And I really am bullish on the actual underlying fundamental economy, because I think that the effects of fiscal have been greatly underappreciated.
So, do you see that as one of the major contributing factors to, as you said earlier, a decade of higher inflation? Let's say, 5%, whatever number you want to put on that. Is that one of the contributing factors, you think?
Oh, it's my number one contributing factor. If I saw the Tea Party get elected tomorrow and we had a situation where they were going to pay down debt and we were going to have fiscal, instead of stimulus, in fact, fiscal contraction, then I would completely change my inflation call. I think, though, that when I examine the kind of Pandora's box that's been opened, and I think about what has changed in 2008, nobody believed the government could spend. I remember everyone saying, citing the Rogoff and Reinhardt book and talking about how there's going to be financial crisis if the government spends, and the key was to pull back and spend less. And that's why it was so tough, because in essence, the central banks were forced to try to do all the heavy lifting. Now we have a situation with COVID. They realized the mistake. They did fiscal. I would argue that they did way too much fiscal. And that's part of the reason that we got such crazy inflation, why we got the meme stock chasing and all that stuff. I think they did too much fiscal. But the kind of ironic thing about it is that you've opened this box up, and yet, we all agree we've had too much fiscal, and yet what are we doing? We're doing more fiscal. And I use the British Prime Minister race as the perfect example of kind of why I think we're going to have more inflation in the future. Britain is facing an inflation that is much higher than the US because of their energy and a variety of different factors. And not only that, they also did like the US and Canada and other countries, and that they spent too much. So they're dealing with this fiscal problem. If we accept the kind of premise that fiscal can create inflation, we should also accept the premise that fiscal contraction can pull it in. At the very least, if you get inflation, the way to solve it is not with more fiscal, right? Like going and doing more stimulus on like cutting taxes is the same as spending more. And yet in Britain, we have one prime minister candidate that is talking about raising taxes to try to combat inflation. And then we have another candidate that's talking about lowering taxes to help with the cost of inflation. Well, we can all agree that the one that says that you should raise taxes is probably the proper policy for Britain, yet he's not winning. And it's the woman that's talking about of cutting taxes. So I look at this and I just say to myself, we've gone down this road. We're going to have more and more fiscal. There's no going back. And that we're going to find that, yes, there's going to be ebbs and flows to inflation, but on the whole, I expect inflation to be much, much higher than it has been over the last 4 decades. We've had 4 decades of disinflation. I think we're going to have at least a decade of inflation, and it's going to be the most difficult thing that investors have to deal with in the coming years.
Mm-hmm. So, Kevin, you mentioned that, in some ways there's a real difference about this point in time. So, considering the balance sheets of the average American, as you said, there's been a lot of cash put directly into their jeans. Could that lead to a very aggressive bounce in the markets once the Fed, as you said, pauses or blinks?
Well, I agree completely, Tom. Like, I think you could get a chase. And in fact, I'm looking at this market and I'm more scared of the bond market than I am about the stock market. Mm-hmm. Imagine if we get a Federal Reserve that doesn't feel they have to choke off growth because inflation's running so hot. And we just talked about the fact that this month's CPI was actually zero inflation. We're taping this on Thursday, and we had the PPI. It was actually deflation. Mm-hmm. Meaning that for this month, it was prices were lower than last month. And if we get a Federal Reserve that is not as hawkish as the market has expected, I could completely see everyone that is, in essence, underweight risk assets and overweight bonds because they were convinced the Fed was going to push us into a recession. You could get a huge shift. And in fact, I've been talking about this a little bit. I'm more scared about a 1987 style setup where we get a situation with stocks rallying into the fall, but the bond market trading like crap. Mm-hmm. And ultimately, I think that the bond market is going to be where the next crisis develops. Everyone sits and stares at the stock market and they thought, because they remember 2008 and they remember credit being the issue. I don't think it's going to be stocks and credit that's going to be the issue. I think it's going to be inflation and, in essence, the bond market.
Well, you've talked about the bond market and the, I forget the exact term you used about the maybe counterweight in most people's portfolio up to this point, right?
Yeah. So it was bonds used to be a ballast to your portfolio, and I believe they'll become an anchor that drags it down.
Yeah, exactly. So a ballast. So why do you think that is changing? Are the signals from the bond, like, the yield curve? We've always heard that if it inverts, or the steepness of it is always an indicator of recession and all these things. Is it now you think that there's a real sea change in the signals that the bond market is putting off?
That's a great question. And I always hesitate, because if I say that I think the bond market has it wrong, I'm basically saying I know better than the whole market, and you worry about anyone who believes that. Having said that, I would ask, in 1981, when Volcker was cranking rates and trying to stamp out inflation through high real rates, the bond market did not believe that inflation would be easily corralled. And if you look at what's known as the real yield, meaning the yield above inflation that investors were demanding to give the money to the government for duration, was extremely high. And the reason was because they thought inflation was coming back. So, let's just imagine it's 1981, 10 years are trading, let's just say 15. Inflation had been 12. It's gone down to 8, and 10 years are 15. And you think, well, inflation's 8, shouldn't 10 years be, closer to 12 or whatever? And the reality is investors said, no, inflation's 8, but it's going to go back up to 15. It's going to go back up to 20. And there was a fellow at the time, I talk about him all the time, is Dr. Kaufman. He worked for Salomon Brothers. He's the original Dr. Doom. He kept talking about how there's going to be inflation. And that belief kept it so the real yield that investors demanded to give money to the bank or to the government was higher, and therefore they earned an extra amount than they really should have, meaning that there was a real yield. Now, contrast that in the next kind of decade, it went down, meaning the premium over inflation that the investors demanded decreased because they understood and they expected that the Federal Reserve was going to keep inflation under control. But it didn't go away right away. It took literally a decade, and then it was another decade till they went down to zero. So now we're almost at the opposite. We are at the opposite. We just had inflation that was 8.5, and yet the 10-year went up to 3.5 or something. So it was -5 on real yield. Now I understand that tips are the real way to look at real yield, and it wasn't really -5 that way because inflation was just a static one moment in time versus a 10-year. But regardless, we have a situation where the bond market, even though everyone talks about how the Fed has missed the boat in terms of inflation and how they made such a great mistake, yet the bond market is inverting the curve. And the reason they're inverting the curve is because they're convinced that the Fed's going to they're going to put us into recession, and that they're going to get inflation under control. If you really, as a long bond investor, believed that the Fed had lost control of monetary policy and that inflation was going to run much higher, you would do the exact opposite price reaction that's occurred. So the bond market is even though people will talk about the Fed losing control of, getting behind on inflation, the bond market's saying that no such thing. The bond market is actually saying, no, not a chance. They've completely got it. And in fact, we believe that they're going to get inflation back down. I suspect that we are going to see a change in the coming years when bit by bit, the bond market gets increasingly worried that the Fed hasn't got it all under control like they think they have. And I know that kind of seems like an odd thing to say, because when you kind of turn on financial news, or you go and you get onto Twitter, it seems like everyone's saying, oh, the Fed's completely lost it, and stuff the Fed, they've lost the plot, and everyone's, it's a disaster. Well, the reality is the bond market doesn't believe that. That's not what the bond market's saying. And I think before this is all through, the bond market will agree with the hyperbole that's on TV and on Doom FinTwit, because eventually they will allow inflation to run too hot. And so going back to the bonds, if you own them in your portfolio before, along with an equity portfolio, it was the perfect kind of hedge in that they were negatively correlated with stocks, meaning that when stocks went down, the bonds went up. And not only that, because we were in a period of 40 years of disinflation and interest rates going lower and lower, you also won on that aspect. So a lot of people created either a 60-40 portfolio where they own 60% equities, 40% bonds, and that kind of helped mute it, or you had a variation of the Ray Dalio, Bridgewater risk parity portfolios, where they actually take that relationship and exploit it by levering up the bond portfolio portion of it. So what I worry about is that everyone still believes that, and I think that that's part of the reason that bonds are doing what they're doing, because people still believe in that. And if you go look through history, they'll talk about how that's been a great portfolio, but oftentimes they don't go back far enough. And the reason is that we've had 40 years of disinflation. We've only had one environment, and everyone is tuned for that one environment. And if you go back and you look in the 60s and the 70s, you'll see that bonds and stocks were not negatively correlated, and that in periods of inflation, they're often, positively correlated, meaning stocks go down, bonds go down at the same time, or bonds go down and drag stocks down. And I think that's what we're going to experience in the future. And I think that that's what most investors are struggling with. And I suspect that will be the biggest challenge we all face in the coming years.
Mm-hmm. Kevin, as we think about these, seemingly counterpoints really of data, you and I talked about the fact that the US consumer has a lot of cash in their jeans, yet at the same time, we've seen that credit card balances have hit all-time highs. So like, how do you try to kind of parse that out and figure out what the real shape of let's say the average US consumer is?
So you need to be careful about the doom kind of scenario. And I'm not trying to say you shouldn't watch for risks, but let's face it, it always sounds sexier when you talk about all the things that could go wrong. Mm-hmm. You just sound smarter. Like if I got on here and told you how the VIX was doing this and how this credit is doing this and blah, 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 people would be naturally more attracted to it because it's almost like a warning that they want to hear. And it's way better. It's kind of like having an English accent. You just sound smarter. People fear loss much more than they are attracted to gain. Right. And when you sit there, and one of my favorite analysts out there is this fellow by the name of Marco Popic. And Marco used to work for bank credit analyst, and then he went and he works for Hightower, and he's a geopolitical analyst. And he tells the story, and I think that it really is important to think about this, because I think it's a very useful story for everyone to think about. When he was at bank credit analyst, he was a geopolitical analyst, meaning that he was, he's a history major, but he was trying to intertwine the politics and the military with how it's going to affect the markets. And almost everything that he would say, he'd get up there and he'd say, well, you go see these institutions, and he'd say, I know you're worried about XYZ. It's not going to happen. Here's why. And he'd be like, I know you're going to worry about blah, 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 blah. It's not going to happen. Here's why. And he's right. First of all, I think geopolitics is a complete waste of time for almost everyone when it comes to the markets. And the only thing you should be following it is to understand when you should fade things. Like if you think about the people that were the most worried about the Ukraine war at the time when it seemed the scariest was the time that you should have actually sold oil, because it was all priced in. Mm-hmm. And I'm not trying to diminish the human aspect of it, but when you're thinking about the market aspect of it, I think that it's overplayed as a significance, and I think it's often gotten wrong. But going back to this idea about the fact that people are attracted to this negative story, and Marco Popic, he went and his boss took him aside and said, listen, I know your calls are being right, but you got to spice it up. You have to, nobody wants to hear it's going to be okay. Like they want to hear this is the doom scenario, and that's what sells books. And so often that ends up being what permeates, especially through those who follow markets closely. You'll go on to Twitter and you'll notice that 75-80% of the quote unquote smart people are bearish all the time. And it makes a great story, and it sounds really sexy as hell, but I'd rather make money than sound sexy. So I think about the markets, and I think about right now the setup. And even though we've had this rally and we've had this breadth thrust, that shows how across the board the buying has been, and typically this has meant buying for the next, months and even almost a full year. Everyone still believes that we're in a bear market, and we might be. I'm not trying to say we're not. Mm-hmm. I'm just highlighting that don't go and assume just because everyone says that isn't a great setup, that you should be looking for all the things that might could go right. Mm-hmm. Mike could go right there. I got it wrong. Anyways, I'm rambling a little bit there. Do
you think that there's a big difference between Canada and the US, maybe from the consumer or the housing pricing standpoint?
So I am the biggest US housing bull, and I am a huge Canadian housing bear. And I'll just explain really quickly. The US, after the great financial crisis, the consumer did not lever up. And in fact, the consumer levered down and went from 100% of GDP down to 75% of GDP in terms of debt outstanding. I also think that during that time, the millennials didn't buy houses. They formed less families. They didn't buy houses. In Canada, we had nothing like that. The millennials bought houses. We went from being less debt to GDP than you to even more than you were at your peak. I don't have the numbers here, but I think we're like 140 or something. We have created a bubble in our housing, and it's going to be difficult to deal with. I suspect that ultimately the outlet valve will be the Canadian dollar, but I'm not nearly as bullish on our economy as I am on the US economy because of that fact. I like the moment that the Federal Reserve stops raising rates at 50 or 75 a clip, people are going to rush out to buy homes again. And in the US, and I know that seems, a lot of people think I'm crazy, and they're busy forecasting the next great financial crisis in homes. I disagree. I think there's a huge built up demand, and that people are going to be surprised. And here's another thing I just want to kind of highlight, Tom. Everyone assumes the next crisis will look like the last. And I remember this very distinctly in 2005 and 6 and 7, is that everyone was scared of tech stocks. And the reason they were scared of tech stocks is because they remembered 2000. Mm-hmm. And meanwhile, tech stocks were not the problem in the great financial crisis. That wasn't the problem. And I think that they're doing the same. My buddy Cuppy, one of the kind of smartest guys I know in terms of trading, he talks about how everyone has PTSD in the housing market. And I really think that's the case. And from a contrarian point of view, I love it. I think that the U.S. housing stocks and the U.S. housing sector in general is a great place to be invested for the next little while. Mm-hmm.
So, Kevin, as we've seen a lot of the bubbles that we've talked about many times on the show really be inflated over the last, let's say, decade here, has this in reality been a reasonably orderly sell-off to you?
So I think that this was orderly when we look at the index and the market as a whole, I would say, but it was actually amazingly destructive when you look at the non-profitable tech. And that was in some ways, it's actually, I'm encouraged by that, because if you remember back in last Christmas, I started to get really bearish. And the main reason was I just felt that non-profitable tech, and then tech in general, had become too much a part of the index, and that we had the Federal Reserve was showing that they were going to get extremely, hawkish on financial conditions. And I thought that there would be a real destruction in those things. I was lucky enough to get that call right. I'm surprised that it was as orderly as it was. Like another one that surprises me, if you told me that Bitcoin would go from 69,000 to whatever it is, and that we would have all these bankruptcies, and that it wouldn't have leaked into the real economy, and it wouldn't have caused a crisis, I would have thought you were wrong. I've been really surprised at how orderly it has been considering the destruction. Like you go look at the Goldman Sachs non-profitable techs index. What is it, down 80%? Like there's been just an absolute annihilation in that market. And yet really it hasn't been that bad. And so I actually kind of, as I say, I'm encouraged by it. And one of the things that instead of viewing that as a negative, I view it as a positive. It's behind us now. Like, yeah, don't get me wrong. I think those things a lot of those are going to zero. And I'm still worried about the FANG mats. But having said that, a lot of the big destruction has already occurred.
Mm-hmm. You know, when we look at the crypto sell-off that occurred in particular, do you think that there's more risk that needs to get cleansed from that sector, or has much of that cleansing that has been necessary to that market has already happened?
Tom, I'm like the worst guy to ask in crypto because I think crypto's going to zero. Like I understand it all. You know, I'm just the worst because I'm such a skeptic, and I'm not short right now. I was short. Like I actually was really lucky to time some good shorts and trade it. I was lucky enough as well to pull off my short when there hit a point when we were getting all these bad headlines, and I saw all these lenders taking collateral and explaining it and people going out of business, and yet crypto didn't go down. And I said to myself, well, if these are some pretty bad headlines and it's not going down, so I actually covered it pretty well. But to me, there's only two positions to have in crypto, which is like flat or short. So you're just asking the wrong guy, because do I think it's going to get worse and that it's going to eventually implode? Yes. Like I think it's going to, $1,000, and I'm a huge skeptic. Anyways, please don't send me all the reasons it's not. I understand, and just be aware that I'll say this: you guys don't want me on the long side of the crypto, because if you guys get me and convince me, that I'll be the last remnant, the last conversion, and that'll definitely be the top, and they'll head lower. So just embrace my skepticism.
Well, I appreciate the honesty of your answer there, Kevin. And in reality, if the Fed has achieved some of this cooling off of some of the mania, the bubbles, the demand, what will be their impetus for pausing or slowing these rate hikes? Do they get to their break-even target of around 3.5% on the Fed's fund rate, and that they don't have to actually react to something that they've dramatically broken, like the credit markets?
So I think that's a great question, and you phrased it great, because people are misinterpreting what the Fed is saying, and they're when we had the kind of the Powell pivot, what was that, like a month ago? Everyone talked about how Powell is going to stop raising, he's going to cut rates, and the Fed never said that, and they're never going to do that. And I think that what you have to differentiate is the Fed raising rates at 50 or 75 a clip versus the Fed raising at a traditional 25 a clip. Mm-hmm. And my point has been that as inflation comes off and as these things cool, the Fed will still remain restrictive, because at the end of the day, the Fed is a committee, and they're sitting there and they're looking at their indicators, and they're saying, unemployment's 3.5 or whatever it is. Inflation's still, even though this month is being, 0, over the long run, it's 8.5. We have to raise rates. But if they go back to, instead of raising rates at 50 or 75 a clip, back to 25, it looks much different. Mm-hmm. And so when I think about the market, and right now we see Neil Kashkari, the most dovish Fed member around, trying to push back on the bond market. People are misinterpreting what they're trying to accomplish. Neil Kashkari is not saying we're going to raise rates at 75 a clip forever. Neil Kashkari is saying, look at you guys, you have rate cuts priced next year. That's not going to happen. And there's a really strange, and like I talked about, you brought up the yield curve, and if you actually look at it, it's crazy kind of kinked, in that they expect the Federal Reserve to raise rates 125 basis points over the next year, and then cut it all the way back in the next year after that. And what I think is going to happen is that with this easing of inflation pressures, it will allow the Fed to raise rates at a slower pace, thereby allowing the economy to have a better chance of not crashing because of their increased rate of hikes. Mm-hmm. And so people go, that's a pivot. And I'm like, no, it's a pivot against what they were previously doing. And I suspect that we are going to go, if you look at most of the tightenings post 1987, like in all the tightenings, they usually go, apart from 1994, they're almost all 25 a meeting. And they just 25 a meeting, 25 a meeting, 25 a meeting. And it was only because they got so far behind that they did these 50s, 75s, and the market is freaked out about that, assuming that that is their kind of like de facto, like they're going to keep doing that. And my point has always been like, no, they are going to slow down. We are going to go back to 25 a meeting. Like I think we're going to do 50 this next meeting. And then I think it's going to be 25 a meeting for a long time. Mm-hmm. And where the real kind of rubber is going to hit the road, though, Tom, is that let's imagine they do 50 next meeting, and then they just start going 25 a meeting, and the stock market all of a sudden goes, hey, you know what? The economy's not going to fall off a cliff. They can handle this. All of a sudden, the dollar says, hey, wait, instead of us all rushing into the US dollar because the rates are so high, it's not going to be as high as we thought. Not only that, the world economy is looking better. I'm going to go buy some other things. Like we could have a situation where you wake up and we have inflation coming down because the supply pressures are eased, and things are really good, and that we have an economy that's busting along again. Mm-hmm. And I'm actually shocked that the market thinks that they're going to be cutting next year. The only way they're cutting next year is if something breaks. And I'm just not as convinced as everyone else that it's going to break. And not only that, I think that even if it does break, a lot of that is priced in.
You mentioned supply chains kind of easing, Kevin. Do you think that that'll be part of, maybe international supply chains getting back to normal, or that this theme of deglobalization starts to actually start producing?
The deglobalization is going to create more problems on the inflation. It's going to actually be the opposite. If we get deglobalization, it's going to increase it's going to increase inflation because it's going to be higher costs. Mm-hmm. So the problem with this is that people are mixing timeframes again, and it's a problem that occurs all the time. So deglobalization, I am the biggest believer that the world is headed in reverse. Like we had 20 years of globalization, with China joining the WTO, with the fall of the Berlin Wall and all the, of the Iron Curtain, and all those people coming into the economy was pushing down supply of labor, or increasing the supply of labor, pushing down the price of labor. And I think that all those things are going to occur in reverse. And so when I'm thinking about my macro long-term thoughts, I say to myself, we are going to get increasing deglobalization, which is going to cause prices to be higher. And ultimately, it's one of the reasons that I believe that we have inflation that ends up being more of a problem over the ensuing years and maybe even decade. Mm-hmm. But the trouble is, in the meantime, we could have a situation where all these intense pressures that were created from the COVID problems and all the ships that were all, sitting there, not being able to be unloaded, or the fact that if you look, remember we were having all sorts of warnings from Walmarts and Targets. And the reason was because they were having such trouble stocking their inventory. They were over ordering. They were just ordering everything. So that we had kind of a demand glut because everyone was having so much trouble. So the supply declined. And then not only that, the demand was made worse because everyone was worried about the supply. Mm-hmm. And all those things are going to unwind. And we're going to see bit by bit, it's going to go back, and it's going to cause a lot of these pressures on the prices to wane. And is it going back to the old levels? Not a chance. Inflation's here. We're going to have it. It's going to be higher. The difference is, though, what's priced in over the short run. And I think over the short run, we're going to be surprised at how much these things improve that we've been worried about. So actually, I'm an optimist about the short-term pressures on the supply chain, and I'm a pessimist, meaning that I think that there's going to be a lot of increase on prices over the long term, because of the fact is that if we go look at like chips and semiconductor chips and things like those, we're going to have to do it ourselves, and we're not going to be as cheap. It's not going to be as cheap as buying them from China, and that's the end result. And that means that there's going to be more inflation.
Mm-hmm. I appreciate that distinction, because there's so many times that I think, the average person can get confused about exactly the timelines that we're talking about when we're thinking about, so many different pieces of the puzzle that we're trying to keep in our heads and understand, right?
Yeah. No, you're absolutely right.
So, Kevin, considering the possibility of this inflationary decade ahead, I've heard you say that you think that this is actually a great time to have a very focused portfolio to actually make money rather than just a broad approach. So, how do you go about thinking about some of these sectors that you feel that have potential right now, considering this backdrop?
Okay, so first of all, I think when I'm constructing my portfolios for the long term, I'm just taking out that big cap tech. And I think that's the easiest thing you can do, is just, what don't I want to own? And to me, that is the easiest trade to avoid. It's overowned because it's worked for the last 10 years. Everyone, the US has attracted tons of capital because they've, up until COVID, they were the only ones with positive real rates in essence. And they were doing somewhat more fiscal stimulus than the rest of the world. So they did have growth. They did have real rates that were higher. They attracted capital. It was a self-fulfilling prophecy in terms of like tech, was attracted to that area. And those things got priced for perfection. And there's such a large portion of the world index that the easiest thing that an investor can do is just make sure that they are not overexposed to that. Because to me, that's the accident waiting to happen, is that we look back and we have a situation where these stocks go nowhere for years. And I use the example of Microsoft. Microsoft in 1999 rallied up, and I can't remember, it was 40 times earnings or something like that. And it went to let's just imagine it went to $45. In the dot-com bubble, it went back down to $20. It got halved. It took, even though earnings kept growing for the next decade and grew at a decent rate, the reality is it took another decade for it to get back to the price that it was at in 1999. And the reason was because that multiple that people were willing to pay on those earnings was never came close to what they had priced at that period. So when I think about stocks like Tesla is a perfect example. Even if you believe in Tesla, even if you think that he's the greatest, thing since Thomas Edison, and that this is going to dominate the electric vehicle landscape, the reality is that it's going to be difficult for it to grow into the expectations that are priced into that stock. And so when I think about the things that you can do to protect your portfolio, the first thing you can do is just make sure that you don't have exposure to those things. And the easiest way to do it is to make sure that you're going and you're not buying market cap weight indexes. And I've said this before, and I'll say it again, for the average Joe or Josephine, you should have equal weight indexes. And the reason that like a CalPERS or a pension fund doesn't do it is because they run out of liquidity. They can't buy the same amount of the 500 stock in the S&P 500 as they can an Apple. So they need to go and do it by a market cap, but you don't. And if you go look at this is one of the last arbitrages that I think exists. If you go look over the kind of long-term periods over all sorts of different markets, and I think that you could go look at AQR had a study on this. If you're interested, go Google, equal weight indexes, AQR. You'll see that they outperform. And the reason that they outperform is that there's periods and there's long periods, 1, 2, 3, 4 years where they underperform. And most professional money managers can't afford to take that risk. They can't afford to underperform for 4 years. They'll lose all their money because it's all a relative benchmark. So if you're an individual investor and you understand this, you can withstand that kind of risk, and you can live through those relative drawdowns, and you're thinking about things on a longer term basis, you should have an equal weight index. And so I really encourage everyone, go read the research on equal weight indexes. You'll be surprised. And then not only that, because of this rally that we've had in those FANG mats, those big 8 stocks, it's on a relative basis, you're buying really cheap. Okay, now that's what you should avoid, what you can buy. It's kind of like the opposite side of what I just talked about, which was growth, high tech growth. It's like value, and value is difficult. I know there's a lot of controversy in terms of like, how do you define it? And maybe it's dead forever. And whenever I hear someone say the strategy is dead forever, that's worked for like 100 years, I think, it's about to work in spades. So I look at things like energy that's just, even though it's gone a long way, it's still trading dirt cheap. Financials, I looked at, Citibank's a perfect example. It's trading at 0.5 times book, and it's there's a new CEO. She's looking great, and she's turning around the company. To me, those are just stocks that you can own and you don't worry about as much, and that you're going to, I think, will work. And so a combination of different factors, and industrials in general, like anything that's in the real economy versus the financial or meta economy, is what you want to own. Mm-hmm. So, yes, there will be the occasional tech stock that works, but on the whole, I'd much rather own like a bank or, a home builder or an industrial that's making widgets, something like that, that's actually going to benefit from a real economy. I think the real economy is going to surprise people in how strong it is.
Mm-hmm. Well, and Kevin, why I appreciate getting to speak with you is you're not necessarily in the same, echo chamber that some of our listeners can be, some of, doom Twitter can be, all of this stuff. So, do you think that gold has a place in there as well as part of that real economy / maybe, energy commodity side of things?
Yeah. So this is, Tom, you say you appreciate me because I'm not in the doom community, but then when I go into like the MMT or the other side of the community, they don't like me because I'll just say things like, I like gold, and I do think it has a place. Or like MMT, even though I've been interested in it, learned it, and kind of been following it, I've always argued that the end result of it's going to mean more inflation. Mm-hmm. So I truly believe that, I'd like to highlight, it's not our job to figure out what should be and to talk about what should be. It's our job to figure out what will be.
Absolutely.
So whenever I hear someone telling me what should be in terms of Fed policy or in terms of fiscal stimulus or anything, I go, it doesn't matter. I can tell you all my opinions about what I would do if I was running the Fed or what I would do if I was running the government. It doesn't matter. We're trying to figure out what will be. So when I think about MMT is a perfect example, I think that it was coming, and that it did prove that it during COVID was the kind of impetus to enact measures that were very MMT-like. And that I've always argued that the end result of it is going to be more inflation than people think. And it's going to be because you can't turn off the politicians. And you might say to yourself, but then we should have never done it in the first place. Well, we were never debating that. We were debating whether we were going down this road, and that's what matters. And we're headed down this road. And I think the politicians are going to spend more. I think that British prime minister race is the most clear-cut example of how we're going to have more fiscal stimulus, even in the face of higher inflation. So back to gold. Yes, I think that gold has a place. And I do believe that gold is, you almost could argue that if you're thinking about like a risk parity portfolio and you're thinking about an asset that you should own along with your equities, in the past it was bonds, you could say that you might want to replace it with gold or increase your gold exposure. I think the gold has suffered for the last 6 months for two main reasons. We've had a very hawkish central bank that's raised the front end of the yield curve, meaning that real rates have gone up. And then that's also caused the US dollar to rally. So I hear gold bugs or despair that why isn't gold up more? Because they'll look at inflation and say it didn't do what it's wanted to do. It's really not designed as an inflation hedge. It's really designed as a hedge against low real rates. And I look at it and I say to myself, gold actually didn't perform that bad, given the fact that the US dollar's done so well and that rates were so high in terms of the front end of the yield curve. So I'm like, okay, so now we've had a situation where the US dollar's rallied a long way and the Fed's gone, the market has gone, assumed the Fed is going to be extremely hawkish. What are the potential surprises going forward? If the dollar keeps rallying, nobody's going to be surprised. Like that's already built in there. If the Fed, up until recently, if the Fed had been hawkish, no one would be surprised. I look at it and think to myself, I think all the bad news for gold is priced in there as well. And I still think that once they realize that the Fed is not as hawkish as they believe, gold will once again have a place. And I've said this before, and I'll say it again. People tell me that this Federal Reserve has gotten, they understand the mistakes of Arthur Burns, and they're not going to make it. And it's this institutional aversion to inflation. And they send me articles about how, I can't remember which one of the Federal Reserve presidents got interviewed, and he has a picture of Arthur Burns in his actual in his office and all this stuff. And I go, okay, that's great. They could tell you they're not going to be the next Arthur Burns, but let's stop and think about what they did. It took until inflation went to 6% for them to get even remotely hawkish and to think that they had a problem. And even then, they've just been following the market higher. And, I look at this Federal Reserve and I say to myself, this is probably the most dovish Federal Reserve we've ever had. And I suspect that the moment that the political pressure comes off of inflation, they are going to go back to being easy. And that doesn't mean they're going to cut rates. It just means they're not going to be as hawkish as the market expects, and they're going to put up with more inflation than we think. So back to your question about gold. Given my belief that over the long run, we're going to get more inflation, more fiscal, and we're also going to have continued easy central banks, then I think that gold is an important asset to own in your portfolio. And I think that that's what it's going to save you from.
And, interestingly, as we touched on that idea of specific timeframes, like thinking about specific timeframes, I did an interview last week where we looked at the actual chart of 40 years of the M2 money supply versus the price of gold. And it actually accounted for that inflation or the destruction of your purchasing power perfectly. But again, that's over a 40-year time span. So it's important to think about, exactly as we said earlier, that particular unit of time that we're thinking about, not just, inflation over the last 2 years has gone where it has, and yet gold hasn't, accounted for that. Well, over time, it's very likely to, but, it won't necessarily react,
What's that line about?
Month for a month.
An ounce of gold will buy you a nice suit in 1929, and it'll still buy you a nice suit. Like it's that I can't remember, but there's something like that where they look at the purchasing power of gold measured in like suits, and it's held the test of time.
Absolutely. Well, Kevin, I think that's a pretty good place to wrap up here for today. Do you have any other thoughts on your mind that you'd like to share with us?
It's always a pleasure being on your show, Tom. I always love your questions. For anyone that's interested, you can feel free to give me an email, kevin@themacrotourist.com, and I'll send you some recent newsletters or anything like that.
Yeah. And of course, you do a lot of excellent writing on your Substack there, The Macro Tourist. And of course, you're an excellent follow on Twitter as well, maybe a counterweight to all the doom at Kevin Muir.
That's correct. Thanks
Excellent.
for having me on the show today, Tom.
Thanks, Kev.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.